Scott, I know you've said recently that rising interest rates are actually helping the market now because people want to buy before rates go higher. I think that you were saying that when rates were at 5.23%. What about when it gets above like 6.25%? What happens now? When does it stop being helpful?
Yeah, I think it's just going to continue to fuel the market. And with the possibility of them going even higher, we expect that the market will continue to be quite exuberant.
I mean, I get the sense that people, if you're in a transaction, are rushing to lock things in because you certainly don't want to be caught out in the cold as things are pushing up. But you have to start to think when rates get above 6.25%, not that historically that's incredibly high, but it is very high from where we were a year ago. And that sticker shock has to be slowing down transactions at some point, or at least keeping some buyers out of the market. No?
Well, I think what's slowing down the market is a couple of things. I think buyers have fatigue right now, especially buyers that have been in the market that needed to finance because there's a lot of cash out there. So a lot of the cash buyers have trumped everyone, and the buyers that need mortgages are a little bit tired. And also, let's not forget, we have a severe inventory shortage across all of our regions at Douglas Elliman, and people may think that the market is slowing. It's just that there's nothing to buy. And Florida continues to be so hot right now. We've never seen anything like it. And as you know, it's sort of off season for Florida right now because of the summer months, but it's still very strong.
I mean, I do hear stories from realtors in my area just about how demand is still strong, but maybe it's taking a little longer. Not, houses that were going in 2 days are now maybe taking a week, and instead of having 5 or 6 buyers, there's 1 or 2 to choose from. Are you seeing that in other areas of the country as well?
Yeah, Becky, we're seeing that across all of our regions. And I think it has to do with the fact that we are in the beginning of the summer for a lot of people, and they've just taken a break. But you're right. People are not walking in, buying it on the spot and signing a contract in 24 hours. They're taking their time. And it is a bit frustrating because if you're a seller and you've waited this long, or you're chasing the market, or your pricing is aspirational, you're getting nervous. But they do end up coming back and signing the contracts. And yes, some deals do fall apart, but there are other buyers waiting in the wings.
How would you describe it just in terms of what the Fed is doing and in terms of what the market itself is doing, taking interest rates higher? What level would you say it becomes a problem? Because, look, it's an affordability question. There may be buyers out there. There's a limited amount of supply, but there's also got to be limits to how high prices can go when people are paying so much more to the bank to finance this stuff. How would you kind of describe the market and that interaction?
You're right. If they continue to go higher, and it looks like they will, then prices will soften. They'll have to, because you're right. The affordability factor of the whole transaction, it just becomes too high for the buyers, and they sort of retreat and they take a break. So that's a possibility. And remember, as you know, years ago, the mortgage rates were 16%. So 6.28 is not too bad, but it is much higher than what we've seen in years.